Welcome back to the Bitcoin Business Bureau. I'm your host, as always, LitecoinLeader. Today we're going to talk about two, maybe three stories about Celsius, Bitcoin, Federal Reserve, interest rates, real estate, all that good stuff. And we're going to tie it all together into some perception and visibility and maybe some of my own thoughts at the end about where I think things are going. So stay tuned for all that next. Okay, so there was basically two main stories, one yesterday and one coming later this week. The first one is about Celsius and crypto, and I did a quick Google search on Celsius and crypto, and you could see all the number of stories that popped up, including this one from the Washington Post. They couldn't even spell Ethereum. That's how good of a fact-checking department they have. In their title of the article, they misspelled Ethereum. So good job, Washington Post. So to open that article, it just tells you, I probably shouldn't even be using that one. It's not that good, but it just tells you that Celsius paused all withdrawals, swaps, and transfers between accounts. They could still deposit, which is good because if you had a margin call, we'll talk about that in a moment, you need to add more assets. So let's just say you started with $10,000 of Bitcoin in your Celsius account, and you borrowed 40% of it. So you're allowed up to 50%, but you said, let's just borrow 40%, we'll be okay. You borrow $4,000 against your $10,000. You feel like you're good. You can do whatever you want with that $4,000, withdraw it, buy something else, buy more Bitcoin, and so on. But just keep it simple. You had $10,000 and you borrowed $4,000. Well, now you woke up and all of a sudden your Bitcoin's down to $6,000. Now your loan to value ratio is 67%, which is over the margin line for Celsius. Not Nexo, but Celsius. Nexo's a different company. They're very similar to Celsius, but they have a higher margin number at 83%. Well, Celsius has had a lot of problems with the Luna issue from last month, managing their assets, and now Alec Mashinsky, the president of the company, is kind of working on handling the situation and not creating another fiasco throughout crypto. He froze the assets so that hopefully Bitcoin can recover and he can balance things out. We'll see. But the perception now of the market is not good. So Bitcoin came down. Celsius had issues. Binance also froze their account for withdrawals, which is a major exchange. And now even I've heard rumors of up to 4 others did similar things yesterday. So interesting stuff going on there. So that's the first story. I'm going to talk more about that in a moment. But let me talk about the second story, which is likely to come out and be more of a headline tomorrow, which is the Federal Reserve. Again, they meet about once a month. Sometimes they skip a month. But that last month they met and they changed it by 1/4 of a point or 25 basis points. They finance guys, they are accounting guys. They love to have their own vernacular, their own words, language, whatever. So a basis point, 100 basis points equals 1%. That's all it is. It just makes small numbers look bigger. So 25 basis points is 1/4 of 1%. So, and that's typically the steps that the Federal Reserve moves. So they moved 25 last time. They hinted at 50, and now there's an article that comes out in CNBC yesterday, ahead of the meeting Wednesday, that says they may move at 3/4 of a point or 75 basis points, which seems to come out of nowhere. But to me, this is kind of a little bit of a spin doctor. This is kind of a posturing and kind of a managing perception once again. So this got me thinking about this is already impacting mortgage rates, which are climbing. And I was thinking back in 2008, I'll talk more about this in a moment, but I wanted to share. It made me remember back when I did real estate 15, 20 years ago, and everybody was moving into higher risk mortgages and ARMs and whatever. I just wondered, where are we at with ARMs? Or what an ARM is an adjustable rate mortgage. Rather, most mortgages, they'll do the most common mortgage in the United States is a 30-year fixed mortgage, which means whatever you're borrowing against your house is whatever your loan amount is, it is amortized or spread over 30 years, and you make a payment once a month for 360 payments until it's finally done, or you refinance it or whatever. Now, most mortgages don't last more than 7 to 10 years because you refinance, you sell a home for whatever reason, the mortgage doesn't last for 30 years. But some people look at adjustable rate mortgages as a result, or hybrid mortgages, 723s or 5-year ARM, 7-year ARM, and there's all different kinds of terms, and I could do that in another video, but basically, you could find it all over. But basically, what if they say a 5-year ARM? A 5-year ARM means it's a 5-year fixed rate of adjustable rate mortgages. Then after 5 years, the rate can change to whatever the market dictates. So basically it's buying you time and a better interest rate up front, because in the back end it can get all wonky and who knows what it'll be. Well, so I started looking. I said, well, mortgage rates are going up, and I wonder what the rates are now, and I also wonder what the climate is on ARMs. So I went and looked at the current rate mortgages, and it took me a few sites to go through this. Bank Rate and all these other sites want you to go through this questionnaire and whatnot. I'm not doing that. I just wanted to see this table. So I found it here on NerdWallet, which was easy to find. And it shows you that here's your 30-year fixed rate mortgage at 5.8% and APR 5.957, basically 6. So now when the Fed raises it 50 basis points tomorrow, mortgages are probably going to the 6s or close to 7. So, I used to remember there was a quick and dirty. It was 6 and 6, 6 equals 6, and 7.5 equals 7. So basically, a 6% mortgage equals 6 times whatever your thousands of dollars you borrow. So if you borrow $100,000, your principal and interest mortgage payment will be 6 times it. So 6 times 100 is $600. So for every $100,000 of a mortgage you had, it was a $600 principal and interest payment you had to make. So but the mortgage rates were in the 2s and 3s not too long ago. Last year they were in the 3s, and before that they were like 2.5, especially if you had good credit. These numbers are all for good credit. So just comparing apples to apples, these are your best rates you can find, 6%. But if you look, 15-year it looks more attractive, but it is a higher payment because you're paying on a faster rate. So that's more like 9 or 10 times. So that would be like $1,000 payment versus a $600 payment. But then you start looking at the ARMs. So this is the adjustable rate mortgage, and it's fixed for 3, 5, or 7 years. You can go and you can get a 3.5% or 4.5% mortgage, but it's only going to last for 3 or 5 years. And then you got either a balloon payment or whatever the market dictates. You may have to immediately refi, but it is an event horizon that you're creating for yourself, and you may be worried. If you'd done this 3 years ago, you'd be really in a hard spot now, because your 5-year ARM would expire. You have to go and get a new mortgage rate, whatever it is, and maybe you could get into a 15-year for the balance, but that would still be a higher percentage rate and be a higher payment. Because remember the old story, the old style of the car salesman, and they would always talk about what kind of payment can you afford versus like what do you want to pay for the car. They immediately start working about your payments. America's built on the debt system and payments, how much you can afford each month. So based on that payment per month, they'll try to find a product that gives you that payment so you can afford to buy the product. That could be a car, a boat, a timeshare, whatever. But houses are the number one that start doing that. And if you can't afford your payments, so the difference between a 3% and a 6% is nearly double. Not quite double in your payments, but if these mortgage rates go up to 7, you're basically going to be paying twice as much of your mortgage rate, because 7.5% would be a $7 per 100,000, $7 per $1,000 that you borrow. So it's be $700 for a payment of a $100,000 mortgage. It would be $1,400 if it was a $200,000 mortgage, and so on. But for simple rules, it's a multiple of 7 times the number of thousands you buy. That's at a 7.5%. The multiple of 3.5 lies somewhere in the 2 to 3 range. So we've gone basically double in a couple of years. So that's painful for people trying to buy a house, and that's why most of your buyers are not cash buyers, and I've talked about that before. So a lot of the buyers that had to finance are really struggling because payments are twice as high as they used to be. But now, to manage that, they can consider ARMs. So I was curious, where are we at with ARMs today? Because an ARM was really popular towards the last bubble and what they call the GFC, or the global financial collapse, in the 2006 to 2009 era, when there was banks too big to fail, Lehman Brothers, all that stuff. So I went and found this other article, CNBC. This is from May 11th. ARM demand surges to 14-year high as home buyers try to afford this pricey spring market. So I didn't really highlight too much in here. The numbers are different, but it just says that ARM demand doubled. The share of ARM increased to 11% of all overall loans and to 19% by dollar volume. So 1 out of every 5 people are now getting an ARM versus a 30-year fixed. And that was all the rage when the rates were 2 or 3%, maybe even 4. So it wasn't as painful when you get to 6 or 7. But it's all perception. It's all different realities and viewing things. Like 6 or 7 historically is not a bad mortgage rate. But in the climate we've just come out of for the last few years, where they've held prices down and held interest rates down to 0, it going from 3% to 7% is painful. So let me drop out of this and I'll start summarizing all about this perception and what I expect is going to happen for both Celsius and also the Fed coming up next. So there's a lot to talk about today. I thought about doing 2 videos, but there was so much to talk about. And again, I did over an hour last night with the Tarot Reader and Joanna, which was a lot of fun. Hope you joined us there. And there'll be a regular AMA for CryptoConfidential members that'll be Wednesday night at 7:30. So that's tomorrow. And then I have a special show that's coming out on Thursday, or probably this weekend as well, about Theta, but with Daniel Pace, and we'll get to that later. But I wanted to get as much stuff in there today as possible. So, and I'll put the link for CryptoConfidential as well, if you want to join us over there, which is a great way to get more information. But you've heard that story before. Let's go back to the 2 stories. First one, we're going to go in reverse order. The ARMs and the mortgages. The mortgage rates are going to go up. And the Federal Reserve, this is all perception. That story about 0.75% or 75 basis points, you can see it's a little bit easier to say. That's pure fiction, I believe. I believe that we're only going to see 50 basis points tomorrow, and we're going to see 0.5% move, which is high. Like the Fed hadn't done much in the last couple of years. They basically lowered it to almost 0. So the previous administration forced them to do that, and it kept the economy rolling. But now they're running out of runway, and the only thing the Fed has left to do is to raise rates. So they raised it. They hinted at it last winter, and then they raised it to 0.25%. In the last meeting, which was in May, they raised it 25 basis points, and they hinted that they might go to 50. Well, now we fast forward a month later, and now there's this story that comes out that there's a possibility of 75 basis points. Well, again, perception. Just like mortgage rates when they were 11%, 7% sounds great. But when you're at 3%, 7% sounds painful. Same story. Now we're like 25 basis points seemed like a lot when we weren't moving it at all, and now 50 sounds twice as bad. But if you say, hey, we're expecting 75, and all of a sudden it's 50, that puts a positive spin on a negative story. So that's what I expect to happen tomorrow. But I also expect that Jerome Powell, the Fed chair, will come out, have a speech after the meeting and say, we're considering 75 basis points for next meeting. So that's what will probably happen. But the markets will react positively to this news. So I expect Bitcoin and cryptocurrencies and the stock market to all go up tomorrow based on the Federal Reserve. So tomorrow afternoon, after this rate comes out, usually 2 o'clock Eastern, I think is about the time, I think the markets will do well after that for the rest of the week. So we'll see if that plays out. Now, the other story, Celsius. This is again about perception. So the perception is that Celsius is mismanaging their funds. They got issues from the Luna issue that they were involved with a month ago, and they tried to pull out of that. So all these, they froze their assets, which means they really can't do transactional fees. They can't collect money. So they froze basically everything, hoping that the market will correct so they can rebalance and figure out what to do to correct things. Doesn't look good. Even Nexo offered to buy out a lot of the Celsius assets and their accounts, because Nexo doesn't want Celsius to fail or go away, because Nexo is basically in the same business, and if you look hard enough, they have higher margin rates, so they might even be more at risk. So I've seen emails from Abra, Voyager, Nexo, all these people are putting out statements to saying, this is where we're at with DeFi, this is where we're at with Celsius, your funds are fine, you're not at risk. Basically, trying to allay the fears that everyone has right now, because the markets are all crumbling and everyone's looking for a safe haven, they can't find it. So it's all about perception, but it's also about visibility. So I'm going to put a little bit of a tinfoil hat on, and I'll talk more about this on the AMA at CryptoConfidential tomorrow night at 7:30. Please join us there. But I think that what's happening is that the powers that be want to get more into Bitcoin, so they have to drive the price down. As they drive the price down, more margin calls happen. And margin calls are important to have an issue with Celsius and Nexo, because a lot of the miners who used to provide a lot of liquidity of Bitcoin have not been selling the last couple of years because the price had been going up, and they could borrow against their assets. Well, if they over-leveraged themselves in the last 6 months, when Bitcoin was at 60,000, now they're down into the 20,000 range. Well, now margin calls are starting to happen, and now Bitcoin must be sold. So now there is Bitcoin to be purchased on these exchanges or these avenues, and then the powers that be that want to get into Bitcoin can at a discounted price. If you believe that narrative, it sounds almost too logical to not be true. So again, it's about perception and visibility. So the visibility, you can look at how much assets are in Celsius. You can guess that I'd say 2/3 of it is Bitcoin. So if you drive the price, and you can see where their assets are. So if you keep driving the price down to an event like this happens for Celsius, then you start to see there's your pain point. You drive down Bitcoin down to $20,000, scoop up whatever's in the market now, and keep on running, and then you can let it run up again. So because they don't want to crash Bitcoin because they want it. They want to say like, oh, this was temporary, and then they want to move on, blame Celsius for mismanaging funds, and move on. So it's all about perception and visibility for both things. So lots said today. What are your thoughts on this? I would love to hear you down in the comments. Did you like the tarot thing last night? Did you like these two stories? What are your thoughts? Do you expect more arms to be coming back? Do you expect real estate to start to crumble? I know I see lots of stories popping up today, haven't even got to yet, about the real estate probably going to crumble. So there's going to be lots more to come from me. Obviously, this video is a longer one today, but I thought there was a lot to talk about. I didn't do a normal video yesterday, but I think this is a good summary for today. I would love to hear your thoughts. So leave them down in the comments below, and like and subscribe and like good stuff, which helps the channel. Really support it. You can subscribe and join the channel as well. But for all that said, I'm going to close the drawer in the bureau for today. Say follow leader one more time, and I will talk to you soon. Take care.